Let's talk some ETFs and thematic investing with Dave Mazza joining us, the Chief Strategy Officer at Round Hill Investments, as stocks bounce back today. Dave, what stands out on your watch list and in your guys' suite of funds, which is growing by the week, month, it seems like?
Yeah, no, Round Hill, we're focused and proud of being able to offer really unique solutions to investors and traders. What I think is interesting today is we look at this market setup. It's kind of a market for everyone, right? Yeah. In the segment before, we're talking about all the positives and all the negatives. Maybe that happens in every market environment, but especially right now today, there's so many question marks about what is going to happen when it comes to the Fed and interest rates. But let's assume for a second that the interest rate hiking cycle is done, or maybe there's 25 basis points left. The cracks in the financial system started a lot sooner this time around than they did previously. And now the Fed, I think, in markets is a little bit skittish about what 2024 begins to look like. In the near term here, though, and I think today's rally is really emblematic of that, is investors are going toward the new defensives every time and anytime there's question marks about what that looks like. And in this market, the new defensives are really big tech and the Magnificent Seven. And our BIGT ETF is one of them that provides precise exposure just to those Magnificent Seven stocks.
Yeah, that's BIGT, right? Which has been around for a couple months and spring, right? So it still is in pretty good shape here, hanging out pretty near the highs, about 27% since the debut. Wow, it really does show how resilient the group has been. And that's just straight top 7 market cap, or is there any discretion on how we define what is magnificent?
Well, of course, magnificent could be a subjective term, but I think the Magnificent Seven is, at least when it comes to stocks, has come to mean some of your OG FANG names plus Nvidia and Tesla. And we actually recently added Nvidia and Tesla to this ETF based off of trader demand and folks saying, hey, when we're looking at what's going on in the market, it's not just your Apples and Microsofts and Alphabets, it's really Nvidia and Tesla that matter too in this space. So we introduced them into the portfolio recently. Even before that, though, you can see the resilience of the group and how strong it's been through what's been a shaky market environment. No one, I think, was expecting equities to be as strong as they were or have been to date, even with some of the wobbles that we've seen. But this group in particular, it actually may be more attractively priced as an entry point than it was before. I think earnings season is going to be really important for these names going forward. They're expected to have better growth than I think we've seen in the past. Now, Nvidia reports later, it might be hard to continue producing those unbelievable numbers that they've been doing. But investors, I think, are looking for some certainty, right? We don't have any certainty when it comes to bonds, but big tech, the Magnificent Seven, have served that. Old defensive sectors like your consumer staples, utilities, they've really been out of favor. They're too interest rate sensitive, I think, to provide that level of certainty that traders are looking for here. And that's why when things get shaky, at least in 2023, it's people are flocking to the Magnificent Seven.
One of the other charts that looks pretty good from your suite of offerings is KNGS, the Dividend Kings, which goes back to the beginning of the year, now up about 19%. It's peaked quite a bit earlier than the Magnificent Seven, so they certainly have had a little bit more lasting power, the big tech companies. But tell me again about this strategy, because I do think that is one that has gone a little bit overlooked, the appreciation for cash-heavy, high-quality companies. As we just heard Jimmy Lee talking about quality, it feels like this is sort of your guys' proxy for quality.
Yeah, I think you're absolutely right. When we think about what tends to do well in times of uncertainty, an area in particular that has done it time and time again, really over decades, is companies that have consistently grown their earnings, consistently grown their cash flow, and that have rewarded shareholders through dividends. Interestingly enough, investors could stay in cash these days and make 5.5%, right? Assuming you pick the right money market fund or ultra short-term ETF. But you know that that's not going to really come with any total return basis. What I think is interesting is folks begin to take a step back and start planning for a multitude of market environments. Those companies that may be boring, again, I'm not saying just go with an entire portfolio of consumer staples or utilities, but have sort of those elements of consistency is what may matter more. You're right. Jimmy Lee was talking about quality. It's been a theme that's gone in and out of favor. It means different things to different folks. But for me, companies with high return on equity, low earnings variability, meaning quarter after quarter, are we expecting them going to hit their numbers? Are going to have one quarter of 20% growth, the next down 20? Companies that can do that consistently are likely going to be rewarded more here, especially when there remains questions about what does inflation look like and what does the pace of interest rates continue to do? And does at some point that come for the consumer? The consumer has kept the U.S. equity market in the game all year. That's why it's been a big outperformer. Now, at some point, I think that likely begins to pull back, perhaps, in our opinion, likely in early 2024. But for the time being, that's why we think investors might want to look for resiliency in the near term. If you're super concerned, I think we got the big tech names can serve that for you, the Magnificent Seven with Big T. And then outside of that, companies with more consistency, dividend growers over the very, very long term could be that as well.
A lot of people look for that in the energy sector. Wanted to talk about that with you real fast. Obviously, crude's up today. You've got a fund that you just put out there that focuses on natural gas, though. The producers of it are stocks connected to LNG. Tell us about it, Dave. We've got about a minute.
Yeah, no, I'll make it quick. LNGG is really the world's first ETF just focused on companies globally involved with liquefied natural gas. This is a transition fuel, right? Everyone's excited about the focus of renewables and solar and what have you. That's going to take decades to get there. We're still going to need carbon intensive source of fuel. Actually, if you look from an emission standpoint, though, natural gas is one of the cleanest or greenest of the carbon space. And we brought LNGG to market to gain access to companies that are involved with this space. Really interesting portfolio, has a relatively high yield. We're expected to have a relatively high yield, about 4.5%. So for investors looking for an emerging theme, something that maybe they haven't heard of, has been forgotten, LNG stocks can be that for them.
All right. I like it. And a little separation between crude and the natural gas to help us to distinguish the parts of the energy market and how to get exposure to it. Dave, thanks for the rundown. Appreciate it.
Thank you.
You got it. Dave Mazza, Round Hill Investments, LNGG, the new natty gas-focused equity fund.